What we're going to be going over here is cost volume profit analysis. We're going to be looking at income evaluations based on taxes. That's where we're going to have to restate our operating income in terms of net income. So we'd be starting with our operating income equation here, and what we have to determine is the operating income or the pre-tax income here that we would need to generate a net income or an after-tax income of a certain amount here. And for our example, we're just looking at a net income or an after-tax income here of $18,000. So we could determine that operating income simply by going to our equation here where we set up. So this would be our targeted net income here that we're looking at, the 18,000 here, would equal the targeted operating income that we have to determine times 1 minus the tax rate. Okay, so we can just rearrange that equation here. So our targeted operating income here is really our targeted net income here divided by 1 minus the tax rate, simply by rearranging that equation. So for our example here, our required operating income, that's going to equal our targeted net income here of 18,000 divided by 1 minus our tax rate here, and I'm going to use 30% for our tax rate. So the difference here is going to give us what, 70%. So 7/10 into 18,000 here is going to give us a required operating income here of $25,800. So that includes the tax here. So we're going to have an operating income here of $25,800 to generate a net income or an after-tax income here of $18,000. And we simply went through this simple equation here. Okay, so now let's look and let's see how this affects our quantities here. So going back to our income equation, this is where we'd have looking at our selling price minus our variable cost times the quantity minus our fixed cost equals our operating income. So we're going to look at both cases here. We're going to look at that operating income here where we didn't have to include any tax. It's going to be the $18,000 amount. That's essentially the same as our net income here. And then we're going to look at the operating income here where we have that tax, that 30% tax. And that's what we calculated to be $25,800. So we could go through this equation. We'll go through this equation here and maybe a good practice example here where we're going to have some grouped products or bundled products. Product A and product B are going to be grouped together here, and they're going to have a sales ratio here of 3:1. So for product A, we're going to be selling 3 of product A here, or a quantity of 3 of product A for each product, 1 of product B. So that's where we got our sales ratio here. A, we're selling 3 of A for every 1 of B. So just plugging those numbers into our operating equation, I'll just go through it here real briefly. So our product A, we have a $2 here selling price here in product A, $1.40 here for our variable cost. So a contribution margin per unit here is 60 cents, and we're going to have 3 times that here because that's our sales ratio. Plus we would add to our product B to it, $3 here selling price, $1.80 variable cost. Contribution, the difference gives us a contribution margin of $1.20 times a quantity of 1 here. And then we'd have to subtract out our fixed cost. And that's going to equal our income here without that tax, that $18,000. So just rearranging our equation, moving our fixed cost over to our income side of the equation here, that's going to give us $80,000 here. And just summing our contribution margins here, we're going to come up with a total contribution margin for A and B at $3. And solving for Q, $3 divided into 30,000 is going to give us grouped or bundles here for A and B of 10,000. So we got to sell 10,000 bundles or groups here of A and B here just for the $18,000 here in income. That's that. Where we don't have any taxes included. And just looking at it in terms of quantities for products A and B here, well, B has got 1 per bundle here or group, so we'd have to sell 10,000 of B here, and then 3 per group here of A for 30,000 here. So total amount for A and B, products A and B, will have to sell a quantity of 40,000 just to meet the $18,000 income. Okay, so let's see how this operating income here with the 30% tax, how it affects our quantities. Going through the same example here again, same sales ratio here, putting the same numbers in, except that we set our income here to that taxable amount here that we have 30% at $25,800 moving our fixed costs over on this side of the equation. Again, we come up with the same contribution margin at $3 here for our bundle of A and B here, one bundle times Q. Well, Q after solving for Q here, divide 3 into 37,800. We're going to come up with bundles that we require here of 12,600, and they're going to be, of course, one of product B here, 12,600. We're going to need 12,600 of product B. We're going to have to sell plus 3 times that amount here. Our bundle. We got 3 in a bundle here for product A. That brings us up to 37,800. So total A and B is a quantity of 50,400. That's with that operating income set with that 30% tax rate. So you can see here we moved up because of the tax. We moved up bundle wise or group wise here from 10,000 up to 12,600 here. And quantity wise for both A and B, we're sitting at 40,000. We have to move up to 50,400. So that's how our taxes here affected our quantities. I went through it here, and we went through it here just looking at products here where we had 2 different products. We grouped them together, and then they were based on a sales ratio here, 3 for product A, 1 for product B. Now, we could have determined our quantity required here that we have to sell based on the simple equation here. We've got our fixed cost plus our operating income here, which is really that targeted net income here, a 1 minus the tax rate. And just for this example, it would have been for our operating income here with the 30% tax, it would have been 25,800 here plus our fixed cost here. That sum total divided by our contribution margin per unit, and that was the $3 here, would have brought us up to the quantity required here, the bundle wise here, 12,600. Okay, so that's pretty much how you'd go through it here to determine the quantities here. And again, we went through an example where we had some bundled or group products here based on some sales ratios. Okay, so now let's go up and let's look at our cost volume profit graph here. And I've got that laid out here where, of course, I got it in those bundle groups here across our x-axis and along our y-axis as our dollar amounts here. And then we have our costing line. That's really our variable cost. We have that $12,000 fixed cost that we have to cover our cost. And if we did the contribution margins, had we gone through them and determined our costing on it, we would have had a contribution margin here that we calculated at $3 for every bundle we sold, and that's based on a revenue. We'd have revenues coming in for each that bundle group here at $9, and then our costing would have been $6. So contribution is really the 9 revenues per bundle minus 6 costing of 6 per bundle for $3 here. But before that's pretty much how our graph works here. But I want to point out one thing before we move on here. And that's to do with this operating income. Now remember, your operating income here is really, that's what we were trying to find, that targeted operating income here to meet a certain specified net income. But remember, the operating income is really, you'd have to add to your operating income here any non-operating revenues, and you'd have to subtract that any non-operating cost. And then you'd also have to subtract out your income taxes. But for this example, we just ignored the non-operating revenues and non-operating costs here. But they would also have to be included to correctly determine any income requirements. We're just using for the example here that income taxes that we would be subtracting from our operating income to meet that targeted net income. Okay, so now let's go back to this graph here, not to get everything confused here. But I got a revenues line showing here, costing line showing here, and then what I have here, I have set up, looking at it versus those bundles that we have to sell. Without tax, I have showing 10,000 here, those bundles we have to show, and based on that, we're going to taking 10,000 times our contribution margin. This is where we came up with that 30,000 here in total contribution margin. Now, that's without the tax here. Now, looking at the tax, the case here is we moved up from 10,000 to up 12,600 here in the number of bundles. That moved up our costing line here, and our we calculated that contribution margin here would have been the $3 per bundle times 12,600 $37,800. So this is what we only have to look at a contribution here of $30,000 pre-tax, but if we have the total tax here, if we have to include the amount of operating income here for the tax, we're going to have to move up that extra contribution here from $30,000 up to $37,800. So we're going to require some extra money here, or dollars here, required for the tax. And just looking at it in terms of revenue here, based on our revenue lines, we'd be moving up from $90,000 to $113,000 approximately. So without the tax, all we'd have to do is generate revenues here, $90,000. With the tax, we now have to generate revenues here of $113,000, just to put it in perspective. So now let's just look at our with the tax versus no tax here, as far as how we calculate those operating incomes versus our net income. So looking at with our taxes here, this is where those taxes have to be included. Again, we have that contribution of $3 per bundle, 12,600 bundles here. That's the groups of A and B, times the $3 gives us the $37,800, less our fixed cost here of $12,000. We have to cover that. Subtract $12,000 from it. We get the operating income that we targeted here for, that would include the taxes here, $25,800. Our tax rate was 30%. 30% of that is going to give us a tax here of $7,800. Subtract that here from our total contribution here, so we get down to our net income here that we were targeting at $18,000. So you can see operating income here, $25,800, subtracting out our taxes here, brought us down to our net income here of $18,000. But we have to sell 12,600 bundles here. Now if we look at it without the tax, again, $3 per bundle here, contribution margin times 10,000 here, times the $3 gives us 30,000, less our fixed cost here, 12,000, brings us up to our operating income here of 18,000. So you can just see our without the tax, everything matches up our numbers here. Operating income 18,000, that's equal to our net income here of 18,000. This is the case where there would be no tax. This is the case with the tax. So operating income, no tax, was $18,000. With the tax, operating income moved up to $25,800, just for comparison purposes. And then the other thing we want to point out here, this break-even point, didn't matter here with or without the taxes, because the case is here, net income versus operating income here at that break-even point here, that will not change the break-even point because there's no taxes paid. You're not making any money. You don't have to pay any taxes. The break-even point just happened to be 4,000 here. So break-even point is simply the intersection here of your costing line and your revenue line. And remember, your costing line started out here with, you had to start up here higher in your dollar amount by 12,000 because of the fixed cost. Whereas your revenues line starts at zero, sell 0 units, you have 0 revenues. And then one last thing here, just looking at these quantities, of course we can see it in terms of bundles here, 10,000 without the tax, 12,600 with the tax. So we have to sell what, that extra 2,600 bundles or groups of A and B. And in terms of quantities here, without the no tax versus the tax, the bundles again, 10,000 here, no tax. With the tax, we'll have to sell 12,600 bundles or groups here. That gives us a change here, 26%. And then for quantities A and B, or products A and B, of course, we move from product A here. Without the tax, we only have to sell 30,000 of product A, but with the tax, we have to move up to 37,800. Again, an increase here, 26%. And for product B, we were sitting at 10,000. Now we have to move up to 12,600 here, again for a 26% increase. Just went through the graph here so you get some feel or understanding of how these taxes here can affect. When you add in taxes, you also have to look at how it affects your quantities that you have to sell, how it's going to affect your sales dollars here, how much extra dollars you're going to have to generate in order to cover those taxes. Okay, so that'll pretty much summarize our discussion.